Hello, everybody. My name is Yaman, and I provide daily updates on markets and technology. Let's get started. Markets are down slightly today. Dow Jones is down 0.3%. Nasdaq is down 0.2%. S&P 500 0.2%. Russell 2000 down 0.3%. You can see Nvidia is up 2.5%, and most everything else is down. Tesla is down 2.2%. We're going to get to that in a little bit. Oil is at $62 per barrel. Yield curve is pretty much unchanged. Wall Street ticks lower after Powell offers no new guidance on the rate outlook. Wall Street's main indices edged lower on Thursday after Federal Reserve Chair Jerome Powell offered no fresh policy signals, leaving investors to rely on older data to shape sentiment. While markets have priced in aggressive interest rate cuts on hopes that Fed will prioritize labor market support, minutes from the central bank's September meeting released on Wednesday showed lingering inflation concerns. Investors will also tune in remarks from other Fed speakers, including Board Governor Michael Barr and San Francisco Fed President Mary Daly. Any hawkish tilt from policymakers could weigh on equities, which have held strong even during a seasonally weak stretch, partly on expectations of lower rates. Quote, "We're headed for a big correction, but that correction is not likely to happen for a few months," said Peter Cardillo, chief market economist at Spartan Capital Securities. S&P 500 consumer discretionary stocks fell 1% as Tesla slipped 2%, Amazon lost 1%. Tesla declined after the U.S. National Highway Traffic Safety Administration said it was opening an investigation into 2.9 million of its vehicles equipped with full self-driving system. S&P 500 industrial sector fell 1%. Tech stocks rose slightly, led by 2.7% gain in Nvidia. Traders are also turning their attention to the earnings season as official data releases remain halted with the government shutdown now in its second week. Company forecasts and executive commentary are expected to serve as indicators of crucial insights into the economic outlook. While their correlation with official data varies, some of these proxies have shown worrying trends. Earlier this week, investment firm Carlyle estimated that U.S. employers added just 17,000 jobs last month, far below the 54,000 estimated by economists polled by Reuters in the non-farm payrolls survey. The six largest U.S. banks are expected to report stronger third-quarter earnings next week, bolstered by a rebound in investment banking. Separately, spot gold prices held about $4,000 an ounce after breaching the milestone for the first time earlier this week. Bullion's gains have highlighted strong demand for hedging, even as investors chase momentum in equities. However, Israel and Hamas signing off on the first phase of a proposed Gaza peace deal could help remove long-term overhang on risk assets. I don't think there was any long-term overhang because of that on risk assets. Among stocks, Delta Airlines shares jumped 5%. The airline provided an upbeat forecast for the current quarter after posting stronger than expected third-quarter earnings. Other U.S. carriers also gained. United Airlines rose 3%, while American Airlines and JetBlue advanced 2% and 1% respectively. U.S. retailer Costco rose 2.5% a day after reporting sales data for September. Lithium producer Albemarle rose 8% after brokerage TD Cowen raised price target on the stock as China tightened export controls on rare earths. Let's move on to Tesla. Tesla's full self-driving faces another federal safety probe. U.S. other safety regulators are investigating Tesla over incidents in which its vehicles drove through red lights and violated other traffic laws while using the company's partial automation software. The NHTSA said it's aware of 58 incidents, including instances in which Tesla drove in the wrong direction on the road that involved the driver assistance system marketed as full self-driving. The so-called preliminary evaluation involves an estimated 2.9 million vehicles, according to a filing posted on the agency's website. Tesla didn't immediately respond to a request for comment. The probe broadens the scrutiny of Tesla's driver assistance technology and adds to other investigations into automakers' doors, autopilot features, and whether it's reporting crashes in a timely manner. NHTSA said last year that it was looking into whether FSD has the ability to detect and appropriately respond to fog and other reduced visibility conditions. The system known as FSD is central to CEO Elon Musk's long-standing effort to develop driverless cars. While drivers are required to constantly supervise when the system is in use, Musk has predicted that drivers in certain states will soon no longer need to pay attention when FSD is engaged. He's been predicting that for the last decade. Tesla shares fell 2% before pre-market. It's still about there. Several of the incidents cited in the new probe resulted in crashes and injuries. NHTSA said none of the incidents in the scope of its current investigation involve a fatality. The regulator said it had identified 6 reports where Tesla vehicle with FSD engaged, approached an intersection with a red traffic signal, continued to travel into the intersection against the red light, and was subsequently involved in a crash with other vehicles. That's amazing. Multiple incidents occurred at the same intersection in Maryland. NHTSA said Tesla has since taken action to address the issue at this intersection. The probe was opened to assess the scope, frequency, and potential safety consequences of the FSD behavior cited in the incidents, NHTSA said. Moving on to GM. GM just introduced a 2027 version of its Bolt. Vehicle deliveries will start early next year, so 2026. So it's only a few months away. And I think the volume deliveries are going to be about the same for Bolt and the Model 3 timeline-wise, and potentially even volume-wise. This is the 15th EV in GM's lineup, 255 miles of GM estimated range, 10 to 80% in 26 minutes. GM has claimed that this is 3x faster charging than the outgoing model. Native North America charging standard, built in Kansas City, and the launch edition, this is the kicker, starts at $29,990, with the LT trim coming later at $28,995, so $10,000 cheaper than Tesla's new Model 3 standard, and significantly more interior volume as well. Also, Super Cruise, GM Super Cruise, is about the same capability as Tesla's Autopilot. So, I think this is going to be a very competitive vehicle. Switching to another automaker, Ferrari shares sink by most since 2016 on cautious forecast. Ferrari NV shares plunged the most intraday in 9 years after the car maker issued cautious forecasts that disappointed investors, marring a coming out of party of the company's first electric vehicle. Adjusted earnings will rise to at least 3.6 billion euros, $4.2 billion by 2030. The company said on Thursday. The outlook implies a slower earnings growth rate than what the management offered during the last Capital Markets Day 3 years ago. Wow. Investors are likely to interpret a downshift in EBIT growth from prior history, an equity analyst said. Ferrari fell as much as 16%, the steepest drop since the company listed shares in Milan in January 2016. The stock trading of which was temporarily halted due to volatility is now down about 12% for the year. Expectations were high going into Investor Day, with the share of analysts rating Ferrari stock a buy at the highest in half a decade. The company trades at multiples more akin to luxury goods businesses like Hermes than car makers, and its shares hit an all-time high in February. Some analysts were anticipating potential lowering of EV targets would supercharge Ferrari's earnings. In a September report, analysts at Deutsche Bank said they expected the company to unveil ambitious midterm targets, citing proposed prospects for the limited edition F80 supercar. Ferrari offered incremental upgrades to its outlook for this year, calling for net revenue to equal or exceed 7.1 billion euros, up from a prior guidance of $7 billion euros or more. For 2030, Ferrari's adjusted EBITDA margin of over 40% compares to analysts' average estimate of 42%, according to Bloomberg Intelligence. So, light forecasts versus high expectations. Okay. That means a high multiple stock. All right, let's switch to NVIDIA. There's a couple of news on NVIDIA. NVIDIA's stock climbs amid reported UAE export approval. Wall Street price target raise. This is not a bubble. NVIDIA stock touched a new intraday all-time high of $195 per share Thursday after Bloomberg reported that U.S. government has approved for export several $billion worth of tech giants chips to the UAE. The Commerce Department issued NVIDIA its export license to UAE after the Federation solidified earlier commitments to making reciprocal investments in the U.S., Bloomberg reported, citing an unnamed U.S. official, marking the first time NVIDIA has been allowed to ship its AI chips to the country since Trump became president. The move follows the announcement of a massive AI infrastructure project called Stargate UAE during President Trump's visit to the country earlier this year. The project, unveiled in May, included a proposed 5 gigawatt data center hub in Abu Dhabi, managed in part by OpenAI and Oracle, with infrastructure supplied by Cisco and NVIDIA. Trump's AI deals with the UAE and Saudi Arabia have opened up new potential international markets for NVIDIA as geopolitical tensions cloud its prospects in the China AI market. Although the US government lifted a short lived surprise export ban on sales of NVIDIA's chips to China in exchange for a cut of its revenue from the region, a highly unusual arrangement that has yet to be finalized, China has now reportedly banned tech companies from buying NVIDIA's chips. In another boost to NVIDIA stock on Thursday, Cantor analyst published a note raising his price target on the company to a Wall Street high of $300 from $240, dismissing the recent growing fears of an AI bubble. We are still in the early innings of a multi-trillion-dollar AI infrastructure build-out, with just the hyperscalers providing significant line of sight into hundreds of billions of dollars worth of demand for the next handful of years, Musa wrote. Hyperscalers are big tech cloud providers such as Microsoft and Alphabet-owned Google. Musa's view highlights the bull side of the AI bubble debate, which sees big tech as justifiably rushing to build data centers to meet unprecedented AI demand. Thus, this is not a bubble, and we're still in the early innings of the investment cycle, Moose wrote. CEO Jensen Huang also added to optimism over NVIDIA in comments to CNBC Wednesday, saying that demand for the company's technology is showing no signs of slowing down. Quote, demand for Blackwell is really, really high, Huang said on CNBC. I think we're at the beginning of a new build-out, beginning of a new industrial revolution, end quote. In other NVIDIA news, NVIDIA-backed Reflection AI raises $2 billion in funding, boosts valuation to $8 billion. Reflection AI, a startup backed by NVIDIA, said on Thursday it has raised $2 billion in new funding round that values the company at $8 billion, as investor interest in the AI remains unabated. The funding round, led by NVIDIA, saw participation from prominent investors, including former Google CEO Eric Schmidt, Citi, and Donald Trump Jr.-backed private equity firm 1789 Capital, as well as existing investors in Lightspeed and Square. Founded in 2024 by former DeepMind researchers Misha Laskin and Ioannis Antonologou, Reflection develops tools that automate software development, a fast-growing use case for AI. The investment comes as the AI sector continues to attract significant interest from venture capital firms and investors. Global venture funding in the third quarter of 2025 rose 38% from the year earlier to $97 billion, with around 46% of the total invested in AI firms. Reflection's new valuation marks a sharp step up from its previous round, when it raised $130 million at $545 million valuation, according to PitchBook data. So that's more than a 10x. The company's peers in the AI market include OpenAI, and China's DeepSeek. Other chip news. Intel unveils Core Ultra Series 3 chip in major test for ailing chipmaker. Intel on Thursday took the wraps of its new Core Ultra Series 3 processor, codenamed Panther Lake, the company's first chip built using its long gestating 18A process technology. The chip is also the first processor to be manufactured at Intel's new opened Fab 52 plant in Arizona. Intel said its 18A process is the world's most advanced process technology researched, developed, and built in America. Core Ultra Series 3 chips will go into high-volume production this year and begin shipping before the end of the year. The announcement is a win for Intel on two fronts. The first is that the company is finally shipping a product using 18A, which has faced delays due to the introduction of the new ribbon FET gate-all-around transistors with PowerVia designed to improve performance and energy efficiency. Producing the new chips in Arizona also helps solidify Intel's commitment to U.S. manufacturing at a time when Trump administration is focusing on onshoring semiconductor fabrication. Intel said its Core Ultra Series 3 processor will come in three main flavors: an 8-core CPU variant with up to 4xe GPU cores, a 16-core CPU option with up to 4xe GPU cores, and a 16-core CPU with up to 12xe GPU cores. The chip can also support up to 96 gigabytes of memory and offers up to 180 trillion operations per second, a common measure of AI performance. According to Intel, Core Ultra Series 3 chips should see up to 50% increase in multi-thread performance and 10% increase in single-thread performance versus the company's previous generation Lunar Lake and Arrow Lake based processors. GPU performance is expected to increase by as much as 50%. Intel will need to prove that its latest chip is powerful while also maintaining long-lasting battery life in laptops. The company has been struggling to maintain its lead in the PC market, with rival AMD gaining ground, thanks to advances in chip performance and energy efficiency. Apple's MacBooks, which run on the company's own custom ARM-based chips, have set the standard for powerful laptops that can easily last an entire workday on a single charge. Qualcomm has also introduced its ARM-based chips for Windows PC, which marry performance and efficiency, adding to Intel's need for a competing offering. In addition to Core Ultra Series 3, Intel showed off its Xeon 6 Plus data center processor based on its 18A tech. If the chip giant is successful and its 18A based chips are everything the company believes they are, they could provide the kind of boost it needs to convince future customers to build their own chips on Intel's process technology. Time will tell. Other cloud news. This distributed data storage startup wants to take on the big cloud. Smiling pictures. The explosion of AI companies has pushed demand for computing power to new extremes, and companies like CoreWeave, Together AI, and Lambda Labs have capitalized on that demand, attracting immense amounts of attention and capital for their ability to offer distributed compute capacity. But most companies still store data with the big three cloud providers, AWS, Google Cloud, and Microsoft Azure, whose storage systems were built to keep data close to their own compute resources, not spread across multiple clouds or regions. Modern AI workloads and AI infrastructure are choosing distributed computing instead of big cloud, Owais Tarek, co-founder and CEO of Tigris Data, told TechCrunch. We want to provide the same option for storage because without storage, compute is nothing. Tigris, founded by the team that developed Uber's storage platform, is building a network of localized data storage centers that it claims can meet the distributed compute needs of modern AI workloads. The startup's AI native storage platform moves with your compute, allows data to automatically replicate to where GPUs are, stores billions of small files, and provides low latency access for training, inference, and agentic workloads, Tarek said. To do all that, Tigris recently raised a $25 million Series A round that was led by Spark Capital and saw participation from existing investors, which include Andreessen Horowitz. TechCrunch has exclusively learned. The startup is going against incumbents who Tarek calls Big Cloud. Tarek feels these incumbents not only offers a more expensive data storage service, but also a less efficient one. AWS, Google Cloud, and Microsoft Azure have historically charged egress fees, dubbed cloud tax, in the industry. If a customer wants to migrate to another cloud provider or download or move their data if they want to, say use a cheaper GPU or train models in different parts of the world simultaneously, think of it like having to pay your gym extra if you want to stop going there. According to Batuhan Taskaya, head of engineering at Fall AI, one of Tigris' customers, those costs once accounted for the majority of Fall's cloud spending. Beyond egress fees, Tarek says there's still the problem of latency with larger cloud providers. Egress fees were just one symptom of a deeper problem: centralized storage that can't keep up with decentralized, high-speed AI ecosystem, he said. That's an interesting point. All right, switching into politics, then macro, and then we're done. Trump says government programs, jobs to be cut amid shutdown. President Trump said on Tuesday that his administration plans to eliminate a number of government programs as a result of the ongoing shutdown, adding that he would provide details on job cuts within the next 4 or 5 days. Okay. On a macro, Fed minutes. Fed last month saw rising risks to job market but remained wary of inflation. Fed officials agreed at their recent policy meeting that risks to the U.S. job market had increased enough to warrant an interest rate cut, but remained wary of high inflation amid a debate about how much borrowing costs were weighing on the economy, minutes of the September 16-17 session showed on Wednesday. Quote, most participants observed that it was appropriate to move the target range for the federal funds rate toward a more neutral setting because they judged that downside risk to employment had increased, said the minutes, which captured the emerging discussion between Fed officials most concerned about protecting the labor market and relatively unconcerned now about inflation, including new Governor Stephen Miron, and those who see signs of inflation remain persistently above the US central bank's 2% target. Yet at the same time, quote, a majority of participants emphasize upside risks to their outlooks for inflation, pointing to inflation readings moving further from 2%, continued uncertainty about the effects of tariffs and other factors, the minutes said. The result was that while most judged that it likely would be appropriate to ease policy further over the remainder of this year, the timing and pace of further moves remain in question within the Fed's divided policy setting committee. Some participants noted that by several measures, monetary policy may not be particularly restrictive, which they judge as warranting a cautious approach toward further rate cuts, the minutes said. A few participants said there was merit in keeping the policy rate steady, while at the other end of the spectrum, one of them advocated for a larger half percentage point cut. Miron, who is on leave from his job as a top White House economic advisor, dissented in favor of a larger half percentage point cut with more to follow at upcoming meetings. Quote, there's a lot of squawking and squabbling at the Fed. Where they stand depends on whether they fear the risk they know, a slowing labor market, or risk they don't know, the possibility of inflation expectations moving higher, said Brian Jacobson, chief economist at Annex Wealth Management. The risks to growth are growing, while the risks to inflation are the same as they were or falling. If September's cut was a risk management cut, it would be hard to argue they shouldn't cut again in October. The Fed cut its benchmark policy rate by a quarter of a percentage point to the 4% and 4.25% range at this meeting last month. Updated projections showed the median policymaker expected two more such cuts through the Fed's two remaining meetings this year. The projections, however, showed a nearly even split among the 19 participants at the meeting, with 9 of them anticipating 2 cuts, and Miron seeing several more, and the remaining 9 seeing only 1 or no further cuts. Investors have set their expectations for 2 cuts, but the minutes showed a textured debate over the risks facing the U.S. economy and over just how much restraint current policy is actually having on investment and spending. Speaking to reporters after the end of last month's meeting, Fed Chair Powell said monetary policy remained at a clearly restrictive level, though he remained non-committal about further reductions in rates. The Fed's next policy meeting is slated for October 28-29, with another quarter percentage point rate cut anticipated by financial markets. The analysis and commentary since last month's meeting, however, have been complicated by a federal government shutdown that has delayed the release of the September jobs report and could postpone publication of the next round of consumer price data scheduled for next week. On that note, thank you very much, everybody, and I will chat with you all next time. Take care.